Hey everyone, Matt Brunig here. I wanted to show you how I tackle a new policy that I haven't seen before. That's just kind of given to me, on the fly. I saw this on Twitter. Someone actually shared it with me and said, "Hey, what do you think of this?" And I haven't really looked too closely at it. I've seen a little bit of a description of it on Twitter, but I wanted to kind of take you through I don't know, the process here. So we have here Senate Bill S9 or S9610. This is in the New York State Senate. We get a little bit of information up here. What we want to do is go to the summary, start there. Provides for a working family's tax credit of $1,500 per child. Okay, so we're talking about basically a child tax credit, $1,500 per child. Directs quarterly prepayment of the credit. So you take the $1,500, you divide it by 4, and you send it out 4 times a year, right? That's what it looks like so far. Provides for a sliding reduction in the credit for incomes which exceed a certain threshold. That's a means test. We're talking about a phase out. So if your income goes above a certain level, you're not going to get the 1,500. You're going to get less than that. And then we got provides such reduction should not be below 1,500. Okay, so it looks like if you're the poorest people get 1,500 per kid paid out 4 times, divide by 4 and you pay that out 4 times a year. Then they start means testing at some point and you get less than 1,500, but you don't ever get below 500. So you start out at 1,500, then the little phase out comes in, and then they bottom out at 500. Immediately. Why do we do this? What is the point of this? And I'm going to go even further. I haven't looked at the rest of the stuff here. If you're going to have a direct payment of the credit, usually that's done as an advanced payment. So it's based on, like this is supposed to be your credit for year 2023, but instead of giving it to you at tax time in 2024, they pay it out during 2023. Okay? So it's a prepayment, an advanced payment of the credit. So immediately, you got to be asking yourself, how do you prepay a $1,500 child tax credit while also means testing it for people who have income above a certain level? How do you figure out how much to reduce the $1,500 by for any given tax unit if it's a prepayment, right? Because you need their income to know whether they exceed the threshold and therefore get phased out. You need to know their income, but you don't know their income because it's a prepayment. You only know their income at the end of the year. So how do you know? How do you phase it out before you know the income? Okay. Let's see. I'm going to try to find the bill text here. Okay. It looks like it's here. Okay. Let's get the summary. We got section 1 redefines the state EITC to be for those without qualifying children. That's actually a good idea. Let's just have an EITC for childless adults and then put the child part of the EITC into a child benefit. I've been saying that for years. That's great. Who cares? Section 3 creates the New York State Working Families Tax Credit. Okay, so that looks like the section we want to go into. So I go into the PDF here. Let's get the text as big as we can without obscuring it. Okay, section 1. Oh, then they go to section 3. Section 3. Okay, this is where the action should be. For taxable years beginning on or after January 1st, 2023, a resident taxpayer with a New York State adjusted gross income of less than $25,000 in the case of an individual who is not married, $50,000 in the case of a joint return, or $25,000 in the case of a married individual filing a separate return shall be allowed a credit equal to $1,500 multiplied by the number of qualifying children. So this is just saying $1,500 credit, right? Same thing here. And the phase out threshold apparently is going to start at $25,000 for singles, for like a single parent, and $50,000 for married parents. That's where the phase out begins. So if you make beyond that, you don't get the full 1,500. You still get the 500, as I recall from the prior part, but you don't get the full 1,500. Okay. So how does the phase out work? We get that the next sentence here. The amount of credit per child shall be reduced, but not below $500 by $20 for each $1,000 by which the taxpayer's adjusted gross income exceeds the $25K and $50K we just discussed before. Okay, so $20 for every $1,000, that's 2%, right? 20 divided by 1,000, that's 2%. So what they're saying is you're going to lose $2, you're going to lose 2 cents for every dollar you earn above 25,000 if you're a single parent, or every dollar you earn above 50,000 if you're a married parent, right? Combining your income. You're going to lose 2 cents for every dollar you earn beyond that of the credit, right? So everyone gets $1,500 if you're a single mother who earns $25,001, we're going to take that $1,500 and we're going to reduce it by 2 cents. And so now it's going to be $14,099.98. And you'll just go like that. Now again, and this was the first piece I wrote, the first video I did. Go look back on it. It says universal benefits cost less than means tested benefits. If the amount of your credit is being reduced by 2 cents for every dollar you earn beyond these two thresholds, that's a tax. That's just a tax. So why put it on the credit when you could just up the tax rate, right? You could just take the tax rate for people making over $25,000 and just up it by 2 percentage points, right? Up the marginal tax rate. And in fact, if you did that above, like for everyone above that threshold, including tax units without kids and including tax units that have like very high incomes, you could probably do like 0.5% or like 0.3%. That's the amount that you could just bump the tax up. And then you don't have to do any of this shit where, you start reducing your benefit by 2 cents on the dollar after these thresholds until you get down to 500 benefit. You don't have to do any of that. You don't have to do any of that. But moving on. So now the question is how? How the fuck do you do this? How do you do this? Not just this is stupid because you can just do the phase out on the tax side. You could just use taxes instead of a phase out. Now the question is, how do you even do this? Right? Because we love these kind of it's going to phase out. It'll just be a means test and then we'll target the benefits, right? It's always like very high level gloss. But now the question is how? How do you do that? What's the administrative mechanism that's going to allow you to figure out who has income above that level in order to reduce their credit before you even know what their income is for the year? Let's see. 2, 3, I don't see it here. Okay, here's 5. This is it. The commissioner shall provide for the prepayment of the working family's credit under this subsection to qualifying taxpayers. 4 advance payments shall be made to such qualifying taxpayers. An estimated annual tax credit shall be determined by the commissioner in advance of the first payment and shall be subject to adjustment due to changes in employment or family status over the course of the year. The first 3 advance payments shall be made during the taxable year and shall be 20% of the anticipated credit. Okay, so here we go. Here's how it works, right? The tax commissioner is going to guess what your income is going to be for the year. It's just going to guess it, right? And that's how they're going to determine whether you get the full 1,500 or you get less than that or you only get the 500. That they're going to guess it, okay? And then they're going to make adjustments during the year. So they're going to start with a guess, and then they're going to adjust during the year based on your changes in employment, right? Because what they realize here is, what if someone had a high income last year? Let's say they made 200 grand or whatever, and they should only get the 500 if they made 200 grand. But what if this year their income went in the toilet and they're only making 10 grand? Well, now they should get 1,500. Well, how do you adjust their payments? Because you don't know that their income went way down yet. You're estimating their income probably based on prior year income, so you don't know that their income has gone down. So how do you do that? And now the answer is they got to report. You got to report changes in employment and family status. So you got to do paperwork. Now you got to have a whole bureaucracy sitting there ready and waiting for all these people to come in to say, my income's gone down. My income's gone down. Can you please up my benefit? My income's gone down. My prepayment needs to go up. All of this processing has to happen, right? And this is all very manual process. And we don't have like these automated tax systems and shit like that. It's forms and social workers and bureaucrats having to process this paper. Okay. Not going to work, first off. It's going to be a fucking headache for a lot of people. Okay. And you're also going to have overpayments. So it's not just that some people had high incomes last year and low incomes this year, and therefore their prepayment needs to be bumped up. You've also got people who had low incomes last year, but had high incomes this year. And if you're paying them the $1,500 up front, that's going to be too much. So they got to try to adjust it down and start reporting their employment and shit like that during the middle of the year to try to be like, stop sending me this money. I'm not owed it. And what else do we have? So weirdly, they say the first 3 payments will be 20% of the anticipated credit. I assume that means 20% for each. So we're going to do 20%, which is $300, right? Yes. $300 payment 1, $300 payment 2, $300 payment 3. That gets you to $900. And then for the 4th payment, you could get $600. But I guess at the point where the 4th payment's coming in, they're going to try to do some calculations to make sure that you actually are owed the $600 and that maybe you didn't get overpaid already and whatever, right? So to make this work, they have to not give you a 1/4 of your payment in the 4 payments. They have to give you a 1/5 of your payment because they want to have enough like fat payment left at the end where they can try to adjust it to deal with the fact that they're going to have overpayments and they don't want to have to claw those payments back. Moving on. Okay, and then here they have a safe harbor here that says if you got overpayments and you weren't like trying to do fraud, we're not going to hold you responsible for that. But this, what this underscores is the point I've been trying to make over and over again, which is that this means testing shit. All this shit in paragraph 5 is unnecessary. You don't need to upfront reduce the $1,500, try to figure out how much of the $1,500 someone should get, right? The alternative to this is instead of having a sliding scale where you only get to $1,500 if you make below 25 grand or 50 grand, and then above that you get reduced by 2% for 2 cents for every dollar you earn beyond the threshold, not to be below $500 for your credit. But you don't have to do any of that. All you do is you take the $1,500, right? You take the $1,500. Where is it in here? Less than 25,000. Oh, here we go. You take the $1,500 times the number of qualifying children, and you pay it out to all families in the state, regardless of their income. Pay it out to all of them. So take the $1,500, divide by 4, pay it out to all of them. That's what you do. And then if you want to say, yeah, but I don't want to really increase the disposable incomes with this program, with this change, I'm not really interested in increasing the disposable incomes of single mothers who have more than $25,000, or, at least not by this much, or married parents who make more than $50,000. If you want to like target it in that way, all you got to do is just bump their tax a little bit, right? Don't phase it out at 2 cents per dollar, requiring this whole fucking mess down here to administer. Don't phase it out at 2 cents on the dollar. Just up their tax by 2% beyond that level. And like I said before, it wouldn't even have to be 2%. It could probably be something more like 0.5%, because you're going to be applying to a broader base and you're going to hit the very rich as well. That's all you got to do. And then you don't have to do any of this. No filing paperwork in the middle of the year saying, oh, I'm getting too much. Oh, I'm getting too little. No, the commissioner has to guess what your income's going to be for the year and then try to adjust it. No, well, we're actually going to give you 20% of your payment instead of 25% of your payment because we want to have a little extra money left at the end to try to maneuver to make sure you don't get overpaid. You don't have to do any of that. Give everyone the $1,500 in 4 payments. And to the extent that you want to make sure that, hey, we don't want this money kind of on net flowing to people over 25 and over 50, up the tax. That's it. And what's the argument against it? Oh, Matt, that's more expensive. It's not more expensive. This 2-cent phase out, where they phase out $20 for every $1,000 of income, that's a tax. That is a tax. It's just a tax administered in the benefit program, requiring a whole other fucking mess of administration to do that you don't need to do, because we already have a tax system that can do that. If you want to reduce someone's income by $20 for every $1,000 of income they earn beyond $25K for singles and $50 for married, that's what the tax code is for. It's unbelievably maddening, and I will direct you back, and I'll put a link in the description to the very first serious video I did on this, which actually uses this exact same example. This is so stupid, and I just, how do we get people's mind right on this so that we don't have this mess? We don't need to put a tax into every benefit program. We don't need to add a phase out to every benefit program. We have a tax system for that. And if we just use the tax system to do the taxing and let the benefit system pay the benefits, everything will be easier for everyone, especially the poorest, who are going to struggle the most dealing with the administrative burdens caused by this phase-out system. Okay? So separate the two streams. Pay the $1,500 to everyone, and then up the tax by 2%, or actually, like I said, 0.5%. That's all you got to do. Problem solved. So I will probably write something on this, but this is my first take, and I might revise it if I read a little bit more, but I think this is it. It's a short bill. It's 3 pages, so madness. It's the same madness over and over again, and no one can defend this. You might say, oh, Matt, there must be people who have good arguments for this. There's none. Nobody has a good argument for this. No one. Zero. Present them to me. I've been doing this for 10 years. I've never seen someone make a good argument for this. I've seen people make confused arguments about this. I've never seen someone make an argument where you're like, oh, yeah, okay, yeah, we just have a difference of perspective about what's important. No, it's just stupidity. That's the other side of this debate. It's stupidity.